Morning, ladies and gents. Let's just allow a couple of minutes for latecomers to join. We'll start soon. Thanks. Okay, I think we're ready to go. Again, good morning, ladies and gents. Welcome to the Prescient Multi-Asset Quarterly Update. I thank you for joining us, and we hope to share the truth, the whole truth, and nothing but the truth with you today. With us is Bastian Teichgreeber. He's the head of our multi-asset boutique, and Rupert Hare, who's a portfolio manager, and I'm Meyer Kutsia. Before I kick off, just to be safe, for those of you who can't see the slides in full screen, just right-click on your screen and click or select the fit to frame, and it should resolve that problem. Now, just a quick reminder before I start. The Prescient Balance Fund was designed with a peer group, which is the multi-asset high equity category, in mind. So what that really means is that the mandate is designed to consistently be around the average of the peer group. And by consistently, we mean we aim to be around that every year. So the asset location and the benchmark compositions for the underlying asset classes are modeled on the peer universe. We then take steps to enhance or add alpha to aim to achieve outperformance above that benchmark, in other words, the peer group. But Bastian and Rupert will talk about that a bit later in more detail. So what we definitely wanted to avoid in this fund was to end up over any 12-month period in the bottom quartile of the rankings. And why is that? Well, it's just basically to inevitably leads to advisors and discretionary fund managers having to face uncomfortable questions from clients. And we know that clients are becoming more and more aware of ranking tables. Okay, so I'm sure you all will feel that aiming for peer average over a shorter period doesn't really sound ambitious, but let me explain quickly. If you look at the graph on the screen now, the rolling one-year periods, this represents over any 12-month period where the Prescient Balance Fund's performance sits relative to the 180, 200, 220 odd funds in that peer group. Now, what we try and aim for is to consistently be above that 50 percentile mark. Now, we've achieved that more often than not, as you can see from this graph, although there were points where we were under that 50 percentile point. However, you should notice that there were no points where we were below the 25 mark, which is the bottom quartile. Now, the beauty is if you move from this one-year peer ranking to the three-year peer ranking, is that power of compounding consistency. So if you look over three-year periods, that more often than not, you tend to do a lot better than the average. And that is just because those that might beat you over a 1 year tend to change from 1 year to the next. So that is typically because fundamental asset manager processes typically results in high conviction bets, but they are, again, typically not great at timing. So the alpha can become lumpy. And this process, or this profile, is even more evident if you look at 5-year periods, where over 3 and 5 years, the present balanced fund return has never been below the top quartile, which we believe is for a long-term investor in the balanced fund space a tremendous outcome. So our process is really simple in nature. It is very much active, but what we share in our process is the characteristics of both active and passive propositions. We say that we offer the best of both worlds. So what are those? We share some characteristics of passive funds, which is low fees. We charge 30 bips per annum in this fund. We have low transaction costs, and that comes through the way we access markets and manage the asset location. And through this process, we have low tracking error. But the characteristics we share from the active space is we're able to generate alpha. We do efficient capital allocation through our strategic asset allocation model, and we capture market dislocations through a robust tactical asset allocation process. And the combination of all these results in highly efficient market exposure. So with that, dear listeners, I'll hand over to our multi-asset guys to share some insights into how we do these things.
Thanks very much, Meyer. What I wanted to do is to just start with a global macroeconomic picture, how we see the world currently. We've been through some pretty tumultuous times year to date. We've questioned whether assumptions are valid. We've questioned whether markets are sane. But at the end of the day, we come out to a conclusion that we're happy with the model as we currently have structured it and the process that we use. So we want to give you some updates on some changes to the base allocations, as well as to some of the tilts that we've got going on at the moment. So just setting the scene from a global macroeconomic picture. In this case, we've got the US employment to population ratio. So what that means is the total population of the United States, including children and the elderly, versus those who are employed. You can see since the recovery after the 2008 financial crisis, it's been steadily ticking upwards, eventually ending up above 80%. But over a period of 1 or 2 months, that dropped right below 70%. It's recovered since then, but it's still at levels which haven't been seen since the early 80s. So that's just one point to make on the employment situation. We've seen markets rallying throughout this whole period, primarily because of a result of infinite quantitative easing, but we think that that is not going to continue for the foreseeable future. So looking at that from another perspective, we've got US unemployment in this case. So same kind of chart, but inverted. We saw a massive spike to almost 15% of unemployment. But also importantly, we saw a spike in underemployment, which is to say that employers have also cut the hours of especially casual workers in the United States to lower than they were before. So the impact of that is less spending power in the United States. We've seen consumption drop quite drastically. It recovered once we had the start of this QE and basically helicopter money, but we think that that can't last forever. Looking at the Fed's balance sheet, we saw in 2008 the first step of quantitative easing. We saw successive rounds of quantitative easing after that. Things started to normalize after 2014, 2015. In fact, the Fed's balance sheet started to decrease. But as soon as this crisis hit, it was the first line of defense that the Fed turned to, and they flooded the market with excess cash, started buying up, particularly in the fixed income space, and we've seen that in asset prices. So with all that in mind, we do a biannual update of our strategic long-term asset allocation within our multi-asset suite. What that refers to is the allocations that we would make if we were to sit back for 30 years and back a portfolio for that period. So in this case, a very long-term time horizon. We don't take as much notice of the shorter-term dislocations in the market. That's our tactical asset allocation, which Bastian will take you through after me. But what we do is we review this if there's any structural changes. So we use a stacked risk premia approach. You can see in this chart, each of the bars are stacked risk premia. At the bottom, we've got those risk premia named. And at the end, we come out to expected returns on the long-term asset classes that we feed into our models. What we've done in this quarter is we've added in 4 new asset classes, those being high yield corporates in South Africa, emerging market local bonds, emerging market dollar corporates, and then developed market income. And we've adjusted our real return on cash, our emerging market sovereign premia, and our equity earnings yield. So just taking you through those in slightly more detail, the real return on cash we've adjusted downwards from 70 bips to 30 bips. I just wanted to show this chart from Visual Capitalist very quickly to show the trend since the 1300s on real returns on cash. You can see that trend is downward sloping. It's almost at zero, and it's something that's been persisting for a long period of time. So to put that into a slightly shorter time period, we can see that the Laubach-Williams natural real rate that's shown in the dotted red line at the top here was higher previously prior to 08, and then during 08 it dropped quite considerably as free money flooded the markets and stabilized until this latest sell-off. So in assessing that real return on cash, which we previously had at 70 bips, we looked at the longer dated real return on cash active contracts, and we looked at the changes in that Laubach-Williams natural real rate. That's also referred to as R star for macroeconomists. And we saw that the longer dated contracts are pricing 10 basis points real return on cash, and the R star is pricing 50 basis points. So we went down the middle at 30 basis points and adjusted our models accordingly. Equity earnings yield. So this is the inverse of the price to earnings ratio. It's a topic which is quite well versed amongst most of us. We read a lot of articles online as to what the new normal may be, whether the US markets, for instance, are over or undervalued, whether tech stocks have influenced that normal PE ratio. What we've seen is that since the 1970s, when we had high equity earnings yields, that equity earnings yield has been suppressed, especially in the late 90s, the 2000s. You start to see tech stocks coming in where growth is the main factor rather than your upfront earnings yields. So we assessed this and we saw that our prior estimation of 6% of equity earnings yield, which is basically a 17 times PE ratio, we revised that to an 18 times PE ratio, which is a 5.5 times, at least 5.5% earnings yield. What that means is that investors are now willing to take less of a premium in order for taking on the risk of investing in equities. And that speaks towards the first point of real returns on cash as well, where we've seen a compression in real returns and people are now willing to take more risk in order to earn a slightly lower premium. In terms of asset classes, we've added in high yield corporate debt in the South African space. We have an internal team at Prescient who specializes in that. We have an expertise that we thought would be wise to lever off in that space. It also offers extremely attractive yields, provided that the holdings are well researched and have low probabilities of default. We've also added in an offshore space, similarly, emerging market corporate bonds, in this case dollar priced, which offers access to a similar opportunity set, slightly, I guess, for the emerging market space, less risky given that it's dollar priced, but it allows us access to over 2,000 names within that sector. Emerging market sovereign bonds, that's in local currency. We've added those in. We saw that they are sufficiently liquid and available for us to trade. Again, this is in a macroeconomic context, so we trade these via futures on indices. We don't trade single names. And then the last one is developed market income, which we use as a filler, if you will. If we've got underweights in the TAA process, then the excess cash goes to developed market income to give us a yield pickup over cash. So in summary, what we've done is that we've expanded our asset classes. That doesn't necessarily mean that we include them in the model. They simply go into the optimization model, and if the data suggests that it is additive to the model, then it adds it to the portfolio. So for the balanced fund, there actually are not that many changes. You can see that on the onshore space, there's a 40% weight towards SA equities, which remains unchanged. Property as well at 5%, that remains unchanged. Both of those, despite the equity earnings yield having come down by 50 basis points. SA bonds reduces. SA income is essentially exploded out into a couple of more granular asset classes. What that allows us to do within the TAA process is to take tilts away from those more individual asset classes based on our TAA signals. Offshore, we remain on our 5% currency hedge. That remains the same. The developed market equities remains exactly the same at 18%. The switch has come within emerging market equities versus developed market bonds. There's been a 2% shift on that side, where developed market bonds have reduced 2% and emerging market equities have increased 2%. So very small changes within the overall strategic asset allocations of the funds, which I think also gives us a bit more credence to our process. We were quite happy with the outcome, given that we'd added in more asset classes. We were happy that the model was robust enough to consider those asset classes, but not necessarily include them within the model for now. If those premia change and those asset classes become more attractive, then they might be included within the portfolios going forward. So with that, that is the foundation of the portfolio. That's our base strategic asset allocation, from which we make tactical tilts based on high conviction. And Bastian is going to take you through those tactical tilts in the next slides.
Thanks, Rupert. And yeah, thanks also from my side to the audience. It's great to see such a good turnout. So gets us very excited to present our views. Before I move into the tactical views, I also want to basically cover quickly what Rupert said overall. And basically the summary is that we see interest rates to stay lower for longer, not just globally, but also in South Africa, but not necessarily lower inflation. So we do think that in South Africa, we've seen the inflation trough. And we do think that in the States or globally, the 2% inflation targets are actually still credible. So the combination of these two leads to just lower real returns. And that's going to affect fixed income asset classes globally. It's also going to affect growth assets, like Rupert alluded to, that we do see the earnings yield of equities lower going forward. So just like it or not, overall going forward, probably a tougher investment environment. All of that also ties in nicely with our big theme, which we started, I think, 2 or 3 years ago, where we said we see a period of heightened inequality, which is a problem. We see demographic tightening, so just an aging population globally. All of that are structural shifts which you need to reflect in your strategic asset allocation. And that's exactly what we've done. COVID was another reason to adjust the asset allocation, but I mean, it just highlights that it's very important to be active also on the strategic asset allocation and not just go with a set in stone strategic allocation through time. Okay. So why am I pronouncing that? I do think that in South Africa, the strategic asset allocation is a part of an investment process which is often neglected. The reason for that is that a few of our competitors are quite equity centric. So there's no negative thing around it, but we do think that having a strategic asset allocation from a top-down point of view is additive. And I'm going to now move on, as Rupert said, drilling more into our tactical views. So what that means is I'm going to highlight where do we see market dislocations and how do we tilt around this long-term optimal, which we have now established. So from top to bottom, right at the top, you see the x-axis, you can see our views. You would see that we have different convictions on the overweight or underweight side. And then on the y-axis, you see the different asset classes, and we split them out into different regions. So all of these views are obviously derived purely systematically. So there's no gut feeling and no human emotion in this. It's all a predefined indicator set, which tells us exactly what to do. So if I start right at the top, United States and even European equities, so those two regions combined give us our developed market equity view, you can see a strong underweight. So that's literally the asset class which we like least at the moment, and we have positioned the balanced fund accordingly. The main reason for that is valuation. So if you look at what the market has done, we have seen a V-shaped recovery, which is not in line with our base case that the economic recovery is not going to be V-shaped, but more U-shaped, or simply in simpler terms, that it will just take some time to get back to trend growth. We go a little bit lower, look at bonds. We do not like United States or European Union bonds. A similar story here. While the economic picture is more in favor of these asset classes simply because the economy is globally slowing, and valuations are again very, very poor. So we see significant real negative real returns in Europe, but now in the States with the US T-bill hitting all-time lows, basically closing in the 10-year rate closing in on the zero line. We also see significantly negative real rates in the States as well. Which asset classes do we like? It's more those asset classes where we still benefit from risk premium. So South African bonds, that's where we at least are in neutral. We see a lot of value, deep value, the real yield being close to all-time highs. Having said that, we also are concerned about the risks, especially once one looks at the fiscal situation. Global emerging markets, we have that overweight. We had a strong overweight on global emerging market bonds. We took that profit early. The reason behind that is that we just once again see a very wide real yield, and that it was just attractive also given monetary policy easing globally and financial conditions easing because of that. Credit globally, we still see reasonably wide spreads, although they are coming in quite fast. So let's see how long we will keep those overweights. And then in terms of real assets, we are neutral on most of the South African real assets, and right at the bottom of the table you can see our rand view. So we are neutral on the rand at these levels. Make no mistake, even after the steep rally which we've seen in the rand remains significantly undervalued. So there's no reason to say, well, the rand has rallied 10-15% from the peak and now it's expensive. It's not. So every valuation model which you would apply would suggest that the rand remains undervalued. Having said that, as for South African bonds, there's a significant amount of risks out there. It's not just locally, but even globally. We are not out of the woods as we think. Okay, let me just drill into those two asset class tilts which we have implemented over the last couple of weeks. The first one would be the strong underweight in US equities. You know this indicator set by now. We look at valuations, economics, financial conditions, and sentiment very systematically. We combine these factors to arrive at an asset class view. For US equities, this is a strong underweight simply because most of the factors in combination point to a negative. The bottom of the page, you can see what we call sub-factors. So those are basically the individual time series, call it, or the individual economic variables which form which are combined to create a factor view. And what stands out on the very left-hand side is obviously that once it comes to valuations, everything is red. So we see elevated price to earnings, price to book, price to sales, and the relative earnings yield is also very, very low. Economics, that's again a picture which is quite mixed actually, but negative on the margin, and then sentiment being very, very poor across the globe. We are quite disappointed that consumer confidence in the States initially pointed to a steep rebound and now came off again. So it sounds like that the US consumer is taking the opinion that we are not out of the woods yet. So all of that obviously does not tie in with the V-shaped recovery which we've seen in the global equity market. You can see that also if you look at the price to earnings ratio. We're looking at the forward price to earnings ratio here, although we like to actually in our models look at the current price to earnings ratio. Nevertheless, we thought this chart is interesting. We are approaching all-time highs here. So forward earnings divided by your price, we are basically pointing towards an equity market which is more expensive than it has been during the dot-com bubble. And we are quite convinced that we will move to an all-time high in this ratio very, very soon. Why? Because the earnings which are going to come through are going to disappoint, and they are not fully discounting the economic impact of this COVID-19 crisis yet. I want to take one step back, and we're speaking about COVID so often and basically continuous, and yeah, it makes me want to speak about something else at some point. We fully acknowledge that it's driving markets, but there's other risks out there as well, and those risks also are leading us to a more negative equity market view, especially when we look overseas. And one of the risks which I would like to highlight is the implications of a Biden tax reform. So to be very clear, I think a change in the presidential administration in the United States would be a great leap for mankind. And without getting too political, I think we can all agree on that. But where I want to get to is that a Biden tax reform is not good for markets, and that's something which we would have to acknowledge. So on the x-axis, we just have all the different components, and the source for this chart is Goldman Sachs, which are coming through from a Biden tax reform, and that just means significantly higher taxes on US corporations. So the first thing, and I mean, Biden is not apologetic about it, and I think he shouldn't be, because probably if one looks at this fiscal situation, some adjustment is necessary. So he wants to move to from a 21 to a 28% corporate tax. He wants to tax foreign earnings stronger. He wants to increase the minimum corporate tax rate. He wants to tax high earners stronger on the social security side, which all makes sense, but it is a quite social agenda, so not good for markets. And then all of that combined obviously has a GDP impact once again, which then leads to lower corporate earnings. So what we're saying is what is not even baked into forward earnings is almost 15% drop in corporate earnings, which obviously would have a massive impact on this price to earnings ratio. So just another reason to outline how expensive markets are. This chart here is also interesting if we just ignore the top left red dot for now and just look at the right hand side. So basically all those small blue dots, what you can see here is that there is a decent correlation between US economic growth or economic growth generally in equity market returns. And the correlation obviously is not perfect, and there must be noise around that. Otherwise, investing would be very, very simple. But there is a decent correlation here, and it should be, right? Because if the global economy, or in this case, the US economy, grows quicker, and we have more corporate revenues. If we have more corporate revenues, we've got more corporate earnings. If we've got more corporate earnings, we've got more dividends. And every dividend discount model will tell us that we can buy equities. But what we're seeing at the top left here, and that is basically this red dot, we are seeing the steepest economic downturn on a quarterly basis since living human memory, and in return, we're seeing the second strongest equity market return on a quarterly basis, which we've ever seen. And those are quarterly numbers, so we went back quite a bit, basically back all the way into the 50s, and we've never seen something like this before. So this economic picture must play a role in our asset allocation view, and it does not move in line with this V-shaped recovery, and it does not suggest that the equity market is on the right track here. So while equities are very, very far forward looking, this picture has to matter, and we have the evidence here that this picture and the economic growth has mattered historically. Okay, so let's get away a little bit from that negativity and into something more positive. So we remain moderately positive on global emerging market bonds. Why do we want to highlight this asset class here? Because we had a strong overweight here as well, which meant that we positioned the balanced fund accordingly. We took that profit early because the economic picture continued to deteriorate. What was a driving force, though, to put on this position? Again, a comparable indicator set. On the very left-hand side, we see valuations again, very wide real yields and very wide relative real yields. So what we mean by relative real yields is the real yield in emerging markets compared to other developed markets. And if I say wide, what we see at this peak was a real yield above 6% in these emerging market bonds. And just to be clear, those emerging market bonds, they're not rand or foreign currency denominated, they're dollar denominated. So it's hard currency. And a lot of these emerging markets are actually investment grade. So if you see a real yield of 6, that is very, very attractive. Another point which I would like to highlight here is, and I didn't highlight that when we spoke about US equities, financial conditions. So financial conditions feed through in a slightly different way to emerging markets bonds than they feed through to developed market equities. They feed through in a way that it's even more important almost. And easy monetary policy across a globe, tightening credit spreads, less funding pressure, and a tight cross-currency basis, that means money is easy to flow into emerging markets, and that's actually all very, very supportive. So what led us to taking off that trade? I mentioned earlier a little bit of economic disappointment measured by the economic surprise index, which is basically comparing the forward-looking economic or basically the printed economic data to what economists were expecting. Let me go into one or two of those factors more in detail. So what we can see on this chart is just the real yield of emerging market bonds, and this is the MB spread. So this is not the real yield in itself. It's actually already the real yield ahead of US Treasuries. And if you get 6% more in emerging market bonds, which are mostly investment grade and all in hard currency, well, then that's an opportunity, and that's why we bought those assets, those bonds, and we sold them only recently again. Another interesting chart, and that was in the beginning a positive economic surprise, but then also a little bit of a negative disappointment a little bit later. So we saw this steep crash, obviously, in the Chinese manufacturing indicator, and what we can see, so the Chinese manufacturing PMI. So what we saw after COVID is this very steep recovery, basically the steepest upward slope which we've seen on track, which made us very, very positive. However, since then, you can see that the positive surprises have faded a little bit. I think there's also a little bit of disappointment that global supply chains will remain disrupted. Remember that for emerging markets, also the US economy is very, very important. And looking at the COVID crisis, it doesn't look that we're coming to a quick solution there. So I think also the fact here that it's tough for countries, even in China, where we had this very harsh lockdown, it's tough to get rid of the virus entirely. So a little bit of disappointment coming through led us to move from a high conviction overweight, strong overweight, to a more moderate overweight, which means that for the present balance fund, we would take off that position. Okay, so that's basically just in a nutshell the tactical tools which we've applied recently. I want to, before I finish the presentation, I want to also quickly elaborate on systematic asset allocation and systematic investing generally during a period of crisis. So how did all of this play out? And we think that it worked well during the crisis, which is evident in the fact that we have delivered on the promise that we're beating our peers during this period. But I thought it's important to bring out some of the elements of our process here a little bit more in detail. So why is it so attractive to follow a process like this during a period like what we're seeing? The first point is that we as human beings, we hate uncertainty, and we like to deal with situations which we know and where we know how to deal with them. And the COVID-19 crisis was a completely new shock. So we all became virologists and knew when the virus is going. We all read up about infection rates and mortality rates, and we all had predictive models telling us when the virus is coming to an end. Most of that has by now been thrown out of the window because the reality is we don't know. But what is important in this environment is that we remain free from human biases, and that's where we where we can rely on a systematic process, which basically tells us what to do. And we are pretty unemotional when going about investment decisions here. So if I combine our strategic asset allocation on a year-to-date basis, it's basically the part which Rupert alluded to, and combine that with our tactical asset allocation tilts, which actually have been a negative contributor this year. If I combine those two and just look at our asset allocation alpha this year, as in 2018, as in 2019, also in 2020, the asset allocation alpha is positive, which we see as encouraging. Stable and predictable outcomes relative to peers. So that's our second point. So as you know, we are not big believers in stock picking. We like to generate alpha on the fixed income side. And that stable and predictable outcome is exactly to allude to what Meyer spoke about in the beginning, when he basically said that if you stock pick, your alpha per definition becomes lumpy. You get the stock picks right and you have a lot of alpha, you get the stock picks wrong and you are prone to underperform. We don't have that. Our numbers suggest that 80% of active stock pickers are not able to beat their benchmark, while only 20% are able to do so. On the fixed income side, however, our research suggests that 80% of active fixed income managers are actually able to beat the benchmark. Why that? Because you can benefit from a risk premium. Very, very easy way. Just take a little bit of credit risk. It can all be investment grade credit. Take a little bit of duration. It can be just 1 year duration, and already you're beating cash. So that's quite feasible. So we do this. We produce this alpha and port it on top of our equity section. Let me move to point 3. Outperformance of peers, slowly but steadily. That is pretty much in line with the Prescient philosophy. So I always don't like if we speak about just trying to be average. Definitely not what we're trying. So we're trying to be in the top quartile as consistently as possible, though. So we want to get there in a very consistent way, and that's basically in line with beating our peers over 1 year periods by a small margin, but doing it all the time. And if you do that, you avoid those negative surprises, you avoid those negative shocks and disappointments, and you just drift up into the first quartile in a very, very smooth and as I think, convenient way. Scalability, and that's my last point, and our last point on our presentation before we open for questions. Scalability, which we like to give back. So our process is highly scalable and it's very efficient to run. So I think we've used the word efficiency too often in this presentation, but where we're trying to get to is we don't need a single analyst to speak to a CEO or a CFO and to try to push to get somehow corporate insights, because this concept just simply doesn't work. So what we do is we have a very qualified team of 7 just in the multi-asset space. Everybody has a data science background and an economic background, and that enables us to make efficient decisions from a top-down basis. The combination of this leads us as an asset manager to be nimble and to run at low cost, and we are happy to give those low costs back, which is why this balanced fund comes at only 30 bips fee. So that's basically our presentation in all briefness, just 35 minutes. We are obviously open for questions. I would love to wish you a safe journey home, but probably most of you are already home. So yes, please let us know if there are any questions.
Thank you, Bastian and Rupert. We received some questions. I'll try and combine some of them as they span some points made. The first one is, how do you align your process to what your peers are doing to ensure that consistent average return is in the top median, in the short to medium return? So essentially, I can answer that is remember, we target the average of the peers. So there might be outliers, but we know there's a big element of herd mentality across the whole sector, which is the multi-asset category. So we just want to look at the average asset location of that sector, the average benchmark of that sector, and trying to do that better. And just remember one thing, Bastian has mentioned now fees a couple of times, more than a couple of times. By charging 30 basis point fee and not having the larger transaction costs as you have in a typically fundamental portfolio, where, for example, you pay 25 basis points for each equity trade, we can keep our trading costs down as well. So we score on average 1% relative to peers just on costs. Now, with a sector and such a large range of funds, there's a huge concentration around the median, and 1% makes a big difference. But I want to add to that another question, Bastian, is for you guys relating to that. It says, with reference to your top quartile performance relative to peers, hasn't the past 5 years just been difficult for fundamental active managers?
Thanks, Bayer. Thank you. Yes, that's a question we actually get quite often. So, yeah, often easy for me to answer that question now, to be honest. So often the argument is made that active stock pickers manage to outperform the peer group more in a bear market. So have they done so now? I don't think so. Another argument often made is, do active managers outperform more, or active stock pickers more during a period where there's higher or more cross-sectional volatility? So if the dispersion between shares is wider, it has never been wider than it has been during this crisis. And once again, we have not seen that outperform. But I don't want to take the position here of a passive fund. To be very clear, our fund is active. We're just active on the asset allocation side, and we're active on the fixed income side, and we port that on top of the equity portion. I would like to actually even take that question one step further, and from a more theoretical point of view, I actually question, to be perfectly honest, a basic assumption in this question that there are even periods of outperformance of active managers or periods of underperformance of active managers. And the reason for that is, and that's also supported by William Sharpe, which he posted in the Financial Analyst Journey already in 1991. If you have a universe and you remove all the costs and all the frictions and all the transaction costs as well, and everything which is making the market imperfect, you will end up with the passive funds being exactly in line with the active funds. It has to be so per definition. Okay, so Jack Bogle actually said that for every 1% outperformance in an active fund, somebody else must underperform by 1%. If you take the same period in the same universe, it just applies. And just think about it, about our market. So if you want to arrive at the market weight of Naspers, and you just strip out all the passives, assuming they have the index weight. For the active guys, if somebody wants to have an underweight in Naspers, or is apparently forced to have an underweight in Naspers, somebody else must have an overweight. Okay, so there's no way around this. So active and passive performance without frictions and without fees must be exactly the same for any given period, as long as the universe is defined correctly, which means that they have the same universe. Okay, so now you add in fees and guess what the outcome is. Obviously, if Mayer mentioned 25 bips transaction costs for just buying shares, and then there's management fees. And so if you add that in, there is no period actually where active, on average, if defined correctly, can outperform passive simply because of the costs.
Okay, thanks, Bastian. If I can maybe ask you to just keep your answers a little shorter. We've got quite a few questions here, which I think are quite important, profound to address. The next one is, is most of your performance contribution from asset allocation or stock selection? In stock selection, it sounds like it means strategy selection. And how wide are TAA ranges? And I maybe just want to add to that, do you find alpha generation on your equity exposure in the fund more challenging considering the low yield environment we are finding ourselves in? Because you referred to generating alpha from the fixed interest market and porting that on an equity index.
Okay. Okay, maybe difficult to answer. That's basically three questions in one. But let me start with the performance attribution, basically. So we have three sources of alpha. The first one would be our strategic asset allocation, which is continuously optimized and which basically already creates a targeted mismatch to the benchmark just being the peer group. So strictly saying, we think that our strategic asset allocation is superior, giving everything which Rupert has alluded to. So that's the first contributor. The second contributor would be our TAA tilts. And the third contributor would be within asset class alpha. We generate that in the fixed income space. So in the fixed income space, we basically create alpha and port it on top of our equity section. So three contributors of return. Historically, over the last 2 or 3 years, asset allocation has been a stronger alpha contributor. We do, however, also put a lot of emphasis on improving the portable alpha process. So if you ask me for the foreseeable future, I would say a third of our alpha will come from the strategic asset allocation, a third of the alpha from the tactical asset allocation, a third of the alpha from portable alpha. And it's exactly this uncorrelated source of alpha, almost equally weighted, which makes the fund so attractive and gives us this reliability in terms of beating the benchmark. That's the first question. The second question was trading bands. Yes, our trading bands are very tight. So to be very clear there, the reason for that is we do not want to take big bets. We are not the manager who moved into cash before this crash, simply because we don't do that. We are trying to beat the average peer. To beat the average peer, we just need a little bit less equity in a crash and a little bit more equity in a rally. Okay. On top of that, we have portable alpha. So our trading ranges are unemotional and purely predefined. So for our developed market equity position, we took a 3% underweight, which is still in the fund right now. Last question was on alpha generation and the low yield environment. Do we find it tougher to generate fixed income alpha in a low yield environment? The opposite is true. So credit spreads have widened. And remember, the portable alpha, the way it works is it is the alpha ahead of cash, which we put on top of the equity section. So whether the cash rate goes up or down is not really affecting us. What is affecting us is wider credit spreads. And wider credit spreads are good for us because it means that the pickup from the portable alpha portion is actually going to be larger going forward. So yes, that's the answer, Mayor. I'm sorry for not keeping it short, but there were 3 questions in one.
Another question here, how do you decide which local equity index to track? There's a massive difference between all these Swix cap versions, etc. So which one is best to track? So I'll quickly answer that one. Yes, we look at the peer universe as a starting point. We strip out all the funder funds, all the factor funds, all the specialist funds like Sharia, all the passive funds, and the remaining universe, we analyze what indices they are tracking. And through this, on the one hand, and through our own optimization process, on the other hand, we arrived at the optimal blend, which is a 50-50 between Swix capped and ALSI. And that is for the time being, unless we see a major shift in industry, the benchmark we'll use on the equity side. Another one here is, where was that? Oh, okay. What is the probability of SA government default and or prescribed assets being introduced? How will bonds be priced in this event through the yield curve? And then kind of tied into that is surely with the predicted interest rate hike, government bonds is not a good bet.
Okay, so probability of a South African government default, we think very, very low. The reason for that is that our foreign holding, the holding of our bonds by foreigners has drifted down quite dramatically, and even less so, even smaller is the allocation to US government bonds. So we cannot print US dollars, so that's where the only risk lies, but our US dollar denominated debt is small. We can print rands. So what that means is there's more a risk of a significant currency sell-off if we really move into tougher and tougher fiscal situation. But I do not think that a default on our government bonds is on the cards. I think that is highly unlikely. I don't want to sound too optimistic. We are equally concerned about the fiscal situation, but we do not think that an outright default on our government bonds is really the risk here. Second part, prescribed assets. So that's a bigger risk, and that's something which by all means we have to, as an industry, I think, where we have to push to try to avoid that. Obviously, an easy way for the government to get the funding mechanism behind SOEs going again, especially with the land bank story. A lot of trust has been lost, which makes it very, very tough for us to lend to SOEs at the same conditions as we've done before the land bank story. So yeah, I think that is a real risk. We hope that the government is not taking that direction, because it's obviously very, very market unfriendly, and it would also send a very poor message to offshore investors, which is not great. Last question, how would the yield curve price all of this? Well, the yield curve has already started pricing that. So if we look at what if we look at the yield curve right now, we see that the South African government bond yield curve is basically at an all-time high when it comes to the steepness. So if you track the 5-year or the 2-year government bond, let's call it 2-year government bond against the 30-year government bond, we can see more steepness than we've ever seen before. Now, that's a function of two factors. The front end is driven lower by the interest rate cuts of the SARB, which is driven by low expectations on inflation. And the back end has moved higher so significantly, mostly because of the fiscal situation. So to answer your question quicker, more steepening would be the message if we see a further deterioration in the financials of the government. Is that something to bet on? Easily, not really, because as said, the curve has accounted for quite a lot there already, and it's tough to move to the front end with the expectation of more steepening, simply because the yields are already so much higher at the back end.
Okay, thanks for that. Possibly a last one here. How was the advent of COVID proactively reflected in your process? In other words, did you pick it up?
Okay, so tough one. So before I even answer that one, I think it has been a period which has been particularly tough for active asset allocation processes, simply because the decline in markets has been so sharp, which means that models are slow, don't have a lot of time to react. At the same point in time, the recovery also has been very, very sharp. So have we picked it up? Have we predicted it even? No, we have not predicted it, because I think it's very, very tough to predict a virus. And I think there's not a lot of active asset managers who have actually managed to predict it. Have we reacted? Yes, we have reacted. Our models react. We have a lot of high frequency data in our models. We use economic surprises, for example, which are published daily. We use investor sentiment, which is published daily. We look at the slope of the yield curve on a daily basis. We look at profit margins on a daily basis. I could go on for a long time. A lot of our indicators are literally updated on a daily basis, some of them even twice a day. So they do trade, that we get signals early and we are able to react quickly. Did we move into cash before this crash? No, but that's not what we're aiming to do. So we reduced equity in time as we think, yes, but we did not move into cash. We would never do that, because we would move away too far from our peer group. Have we delivered on our promise? And the answer to that is clearly yes. Once again, through this crash, as through the last couple of years, we have beaten the average peer. And as May alluded to in the beginning of the presentation, if you now look at 3 years, 5 years, there is no dip in performance. We remain very, very close to the first decile and comfortably in the first quartile, even through this crisis. So no, we didn't pick it up to perfection, but it's not necessary to pick it up to perfection.
Okay, thanks, Bastian. I think we need to leave it there, so we're running out of time. So, ladies and gents, there you have it. A process that is simple, reliable, effective. And that's, frankly, systematic investing. So we rely on data, on evidence, and not on emotions and gut feel. So we sincerely wish for you all to stay safe, and our trade for the day is to remain short COVID-19 and hopefully long Prescient Balance Fund. Have a great week. Bye-bye.
Thank you very much.
Thank you.